In the second part of the agenda today, we will discuss about the theories and also share with you some of the key concepts under investment appraisal topic. And first of all, we would like to share with you, if you would like to check the notes, it's on page 2 of your revision class notes. Here, page 2. Here is about the why NPV is superior to other investment appraisal approaches. Okay, we highlight six reasons to explain why NPV is superior to other investment appraisal approaches. First of all, is the time value of money. Okay, as we share in the lecture as well, NPV is discounted by a factor which is considering the time value of money as compared to accounting rate of return, simple payback. They don't consider any discounting, but for NPV, for net present value, it is a good approach because it considers time value of money. And next is the decision can be clear, no ambiguity. Okay, because it's only one solution, whether the NPV is positive or negative. Okay, if it is positive, then the project can be accepted, and if it is negative, then it is rejected. The rule is very clear. But for internal rate of return, in some circumstances, for example, under non-conventional cash flow circumstance, multiple IRR solutions are possible. So you have to bear in mind why IRR is not superior or not as good as NPV method. The third one is about the profitability of the project. Okay, unlike payback. Okay, payback is only considered about when is your initial investment recovered. But for NPV, it considers all the cash flows of the project that you are putting into the projection. You are putting into the forecast. So it considers both payback as well as the profitability as well. So all cash flow considered then is, as compared to the payback, is much better. And the fourth one is about the opportunity cost, because we are using the discount rate. So we remember discount rate means the cost of capital. Okay, we will cover cost of capital topic in our revision class once we are going into the business finance. So in general, the cost of capital is your opportunity cost of investing by your funds generated or your funds financed in the market, no matter if external funds financed or internal funds generated. Next is about the project risk. Because when we work on the cost of capital, it handles the risk because the discount rate is adjusted by the risk. Okay, we'll share much more on how to get the discount rate. But the simple way is the discount rate is the weighted is the WACC, is the weighted average cost of capital. It includes the return on equity, also the return on debt. Okay, so for ROE, for return on equity, we have a lot of approach like dividend growth model to estimate our return on equity, or you will have the capital asset pricing model, CAPM. For capital asset pricing model, the risk factor is considered. So if we adopting the CAPM, the capital asset pricing model, the project risk will be considered. And consistent with the corporate objectives, because NPV, the NPV is the value generated from the project invest. So finally, it can increase the value of the shareholders shareholders' equity in the company. So it is consistent with the corporate objective. So next topic is okay. What we discussed about the advantages or the good side of NPV. So what's the bad side of the NPV? NPV is commonly used by a lot of investment appraisal in the commercial world, no matter it's in a commercial company or even in an investment bank or consulting company, is a generally accepted rules for projects to evaluate the projects. But there's some limitations on the NPV. So we check it to see what's the limitations on NPV. For example, if the company of the organization is not wealth maximizing, okay, we are talking about not-for-profit organization. So under not-for-profit organization, NPV cannot be adopted because the investment or the spending is mainly for non-profit objectives. And also for NPV, we have to estimate the discount rate. And for the discount rate, we need to incorporate different risk premiums. So here we need to make a lot of assumptions. And for these assumptions, there are limitations on the assumptions. Okay, for example, we assume the past 2 years stock price of a particular company is the benchmark. Okay, and we base on the stock price to estimate the beta. For example, we learned from our lecture that the beta, the equity beta, is one of the measurements or one variables that we need to use in the CAPM, okay, to estimate the return on equity. But for the beta, for how to estimate the beta, we have a lot of assumptions made and also limitations. And the past cannot, for example, the past cannot, or the past doesn't mean the future will follow exactly the same pattern in the past. So here's the limitations on the estimation on discount rate. And third one is about the NPV. Okay, the NPV is good to be adopted with the conventional cash flows, but the complicated mid-period cash flows are present. Then the technique is a bit it's not that easily to use as what we see in the conventional cash flow. So bear in mind, there's not only the internal rate of return, even for the NPV, when the cash flow pattern is not at a conventional way, it's not easy to adopt. Fourth one is not universally employed. For example, the SME, small business environment, they don't like to use the NPV because it's too complicated for them. They would prefer the payback, accounting rate of return, or even internal rate of return, the IRR. For the fifth one is NPV is only limited use if there's any non-quantifiable benefits and costs. Okay, because NPV does not consider or account for any non-financial information. And we just mentioned about the NPV, its good side and bad side. We will cover the other topic, like the accounting rate of return, because in examination, okay, sometimes you are asked to compare ARR and NPV, okay, and you have to know what's the disadvantages of ARR. ARR, first of all, is susceptible to manipulation, okay, as we said before in the mind map, because ARR means the average profit to average investment. Okay, please remember this. Accounting rate of return is calculated as average profit to average investment. Okay, it's very important to remember because when you are asked to do the calculation of ARR or return on capital employed, you are based on this formula. average profits divided by average investment. Okay. And for accounting rate of return, it's subject to the variation of accounting policy. So bear in mind, it is easy to be manipulated. Next is accounting profits. Is taken out of the depreciation provisions. Okay, it's not cash flow. So first is manipulation. The other is double counting because of depreciation counted. Depreciation is the capital charge, right? It's the charge of capital in your profit and loss account, in your P&L. And one important part is because in the formula, you are adopting the average profit divided by average investment. And investment is your capital, okay? And also you counted capital charge in your profit calculation. So it's double counting of your initial outlay. The capital cost is allowed for twice. Okay, so the result is it will depress the measured profitability of a project. So it's too prudent, or in other words, say it's too prudent because you count twice of the capital charges. So sometimes you reject a lot of good investments because you double counted of it. And the third one is it's not time value formula, so it make no allowance of timing to the returns from the project. So three disadvantages mentioned here. First is manipulation for ARR. The second is you double count the capital charges because you deduct the depreciation provisions. The third one is it is not time value formula. Okay, the formula is not time value adjusted. So make no allowance for the timing of returns from the projects. Okay.